I think the thing is, you're right. I don't think it's the analysts' botched estimates, but at the same time, we're coming off of a period where there was absolutely no clarity, right? So in normal times, in pre-pandemic times, and then hopefully again in post-pandemic times, when you're estimating, you can say, well, 2016 was this, 2017 was that, 2018 was the following. And you have really solid bases to estimate off of, but that's not the case. So what we're estimating off of right now is a completely disrupted, murky something from last year. So I get it. And I think that's why we're not seeing crazy upside off of big earnings surprises, because who knows what they were really going to be. You know, the expectations are just, I think, to get back to normal, not really for raw growth and a repeat of the crazy huge returns that we were able to have coming off of this time last year.
Well, in part because we don't know the visibility on the economy. Now, we hear a lot about the COVID numbers, and I want to make it clear to our audience, the majority of the national numbers are skewed by just 3 states, Louisiana, Arkansas, and Florida. So look into your states, but mass mandates are coming back. There's a lot of confusion about whether or not there'll be new shutdowns in the fall, so it's hard to model.
It's super hard to model, although it's a heck of a lot easier to model this year than it was last year. And so it's been interesting listening to the earnings calls. I think about 2/3 of my portfolio, maybe a little bit more at this point, have reported, and it's back to normal. In fact, that was the theme of my quarterly client conference call a couple weeks ago, is that everything's back to normal. So it's hard to model, but it's nothing like hard to model last year. And so what you're seeing is you're seeing companies give realistic estimates for the next year. And by the way, here's a fun one. Apple, right? Apple had huge earnings, but actually their future growth is more in the 3% range next year and the 5% range the following year. Who knows if that comes to pass or not, but those are reasonable earnings growth expectations going forward. And that's what we're seeing. It's hard, Brian, but it's nothing like last year. It's truly a return to normal, both in the tone of the conference calls, with corporations as well as with clients.
Yeah, and nobody that I've heard so far thinks you can shut down. I mean, let's go into a couple of names. On Friday, I don't know if you saw it, not offended if you didn't, was out at Chevron's headquarters in San Ramon, California, for a long-form interview. By the way, the interview up on CNBC.com, about 22 minutes in total. Tried to get into a lot of things. Chevron, a name you like. I mean, they reinstituted a buyback. Their free cash flow is off the charts.
Right. And that's another one where, I mean, think about where we stood last year. Where we stood last year is we'd gone from, what was it, $60 oil to $26 to negative oil prices, had rallied back up a little bit. Where we've gone this year is we've gone from about $40 oil to $50 to $60 to $70. We've been really hovering in the $73 range. So Chevron's able to predict. They're able to see what their free cash flow will be. They've reined in CapEx for a long time, so now they actually are really cash flow positive, generative, and can start to pay that back to shareholders in a really meaningful way. But that's a really perfect example of where clarity is actually returning. So the earnings call can be meaningful the way it was. And here you have a stock that's trading at 14 times earnings and has a 5.3% dividend yield. In a market that's kind of stretched and kind of sketchy in some ways, this is a company that I'm very comfortable sitting tight in.